Did you know that you could spot the next Apple or Amazon before anyone else? Legendary investor Peter Lynch has a secret formula for finding game-changing stocks before they explode. And today, we are unlocking that strategy exclusively for you. In today's video, we are discovering Peter Lynch's genius approach to stock selection. From his favorite investing mantras to his hidden tactics, we will break it all down for you to use his strategy and get ahead of the market. So, if you want to think like the best in the stock market, make sure to watch until the end of the video. Okay, so first things first. Lynch's investment philosophy mainly revolves around investing in companies with which investors are familiar. Because he wants you, as an investor, to have an edge over large institutional investors since, they can notice emerging trends in their everyday lives. He has even mentioned this approach in his books, One Up on Wall Street and Beating the Street. He has always emphasized the fact that as an investor, you should look for companies with compelling stories so that you have a clear vision of why and how those companies have a business that will expand and thrive. This is important because the more familiar you are with a company, the better you can assess its growth potential. Lynch prefers simple businesses that are easy to understand, often saying that he would rather invest in pantyhose rather than communication satellites and motel chains rather than fiber optics. If it isn't clear already, his strategy revolves around the most straightforward and understandable businesses because they allow investors like you to make more informed decisions without relying on complex financial models. Next up is the selection process. Now for this, Lynch employs a bottom-up investment approach. This means that he selects stocks based on individual company merit rather than macroeconomic trends. This strategy encourages investors like you to look for investment ideas in your daily lives, products you use, businesses you work with, and services that you have observed gaining popularity. He has always believed that strong businesses with solid fundamentals will eventually perform well in the market regardless of short-term fluctuations in the economy. Once you find a company that has been caught up in your investor radar, the next step is a thorough analysis of its fundamentals. Now, Lynch emphasizes that it is not necessary to predict specific earning growth rates because what analysts estimate can often be unreliable. Instead, he wants you to evaluate the company's plans for growth, and for that, you can see how the company reduces its costs or raises its price, how a company is expanding itself into new markets, and selling more in existing markets, because a company can increase earnings through several means, so you should keep an eye on all of these areas. Understanding how a company intends to grow its earnings is very important if you want to determine whether it presents a solid investment opportunity or not. Categorizing companies. First, we have to acknowledge Peter Lynch, because he has refined stock selection so well for all investors. He has categorized companies into 6 groups, and it has made things so much easier for us. Okay, so the first category is slow growers. This group includes large, established firms that grow slightly faster than the overall economy and typically pay dividends. But these are not his favorites because they tend to have a limited upside potential. The second one is the stalwarts. These are the companies with steady growth like Coca-Cola and Procter & Gamble. Now, these offer moderate but reliable returns and serve as a safer investment choice. Next up are fast growers, including small and aggressive firms with annual earnings growth of at least 20 to 25%. These are actually Lynch's favorites because of their high return potential. If you find a company in this category, it can result in early extraordinary gains. The next category is the cyclicals. These are the companies with earnings tied to economic cycles, like auto manufacturers and airlines. Investing in such companies requires careful timing because their stock prices can swing dramatically with changes in economic conditions. So if you want to go for these companies, you have to be very careful. The next one is turnarounds. These companies have a great potential for recovery and distress. Chrysler is an example for this. Successful turnarounds can yield quick and significant gains, but they carry high risk. The last category is asset opportunities. It includes companies with undervalued and overlooked assets by Wall Street, such as valuable real estate patents and brand equities. Recognizing these hidden values could lead to significant returns if the market eventually revalued the company properly. This is the easiest way to categorize companies you have an interest in, don't you think? Now let's get into some technical details. So, Lynch emphasizes that investors must analyze financial metrics to determine whether a stock is a good investment or not. For this, you can look at a company's year-by-year earnings. If they show a history of consistent earnings growth, it's a pretty good sign. A company's earnings growth rate can show you if the company's numbers align with its story or not. The next one is the price-to-earnings ratio. This is an extremely important metric as it assesses a company's valuation. High-growth companies typically have a higher price-to-earnings ratio, but this should be justified by strong future earnings potential. Then you can compare this ratio with the historical average because it can show you whether the company's stock is over or undervalued. You can also compare the price-to-earnings ratio with the industry average to assess the company's relative valuation and whether the stock is a good buy compared to other companies in the market. You should also see the company's debt-to-equity ratio because a high debt can be a red flag, especially when it comes from bank loans that can be recalled at any time. And of course, dividends and payout ratio. Large and stable companies often pay dividends, which can enhance returns and provide a steady income for you. Now, even if you find a company that has a great story, you have to make sure that you purchase at a reasonable price to ensure strong returns. Lynch has always warned against buying overvalued stocks because he believes that stock prices eventually align with earnings. Analyzing the valuation metrics that we just discussed, you can avoid overpaying and then maximize your upside potential. As an investor, you have to consider market sentiment as well, because hype and speculation can definitely drive stock prices beyond their intrinsic value. The power of patience. As an investor, your greatest weapon will always be patience, because you have to be patient in the stock market and hold on to winning stocks for the long term. Many of Lynch's most successful investments have taken years to realize their full potential. He highlights that the biggest gains come from fast-growing companies that continue to compound their earnings over time. So rather than panicking during short-term market fluctuations, you should focus on long-term fundamentals. Now, if you are an individual investor, congratulations because you have a distinct advantage over institutional investors. Because unlike large fund managers, you are not restricted by bureaucratic constraints and short-term performance pressures. You can make nimble and informed decisions based on your observation and research. You have full freedom and full power. Let's say that you notice a new restaurant chain gaining popularity. You can investigate the company, and if you recognize its potential, just act upon it and secure that opportunity. Similarly, if you see a company consistently improving its products and expanding its market shares, you can act on that knowledge before institutional investors drive up the stock price. Because you have access to first-hand information, this can lead to significant investment opportunities. The secret to finding the best stocks before everyone else actually lies in a mix of this approach. When you invest in what you know, conduct thorough research, and categorize companies by Peter's standards, you can uncover hidden gems and use the privilege of that information to select the best stocks for yourself. If you find yourself being confused between any companies, you can also talk to a financial assistant. Once you decide on what stock you want to choose, just invest, wait, and achieve your long-awaited long-term financial success. Now, you have Peter Lynch's secret playbook in your hands. What's one stock you believe could be the next big thing? Let us know in the comments below and make sure to subscribe to our channel so that you can stay in the loop and never miss out on any of our videos. Subscribe now. See you in the next video.